but by a couple metrics like price to sales ratios and market capitalization to GDP, the United States has never been more expensive than it is right now. When we have a recession, people always assume that the next recession is going to look like the past recession. And so what happened in the past recession, the 2008, 2009 crisis, and then the aftermath, was that we had, like as you point out, central bank assets were a very small percentage of GDP prior to them, and banks were highly leveraged. So what happened was when the private sector debt bubble blew up, so real estate values went down, all these banks were highly leveraged, they had, very little cash reserves, so they pretty much went insolvent. So the Federal Reserve and the Treasury came in and said, okay, we're going to buy some of these toxic assets from you. We're also going to buy some of the treasuries from you. Basically, we're going to create new base money or Chuck E. Cheese tokens, as you point out. We gave them to the banks and then took some of their assets in return. So the Fed, they took something in return for those assets. Some of those things were worth money, like, treasuries and mortgage-backed securities. Other things ended up being toxic and then kind of, basically filtered through and kind of removed from the private sector. And so one thing I do is I go look, I kind of, I love these long-term data sets. And so, when I hear about how something works, I say, okay, let me go and test that. Let me see how that's actually done in history. So I go look at the data, and then from there, you have to watch out between correlations and causations, right? So you have this data set, so you have this idea, first of all, like a narrative, but everyone's got a narrative, and they say, okay, how does the narrative apply to the data? Then if the data looks good, you have a narrative and a data, and then you kind of stress test it. You say, well, why did this happen this way? Could it have happened this way? And so I try to figure out, what is the actual point of causation? And what are kind of the bottlenecks in the system? Where does something break if it doesn't work like this? And that's actually a really big role in, for example, those giant debt cycles, because usually they have their turning points when things are basically stretched to their absolute limits. And you basically say, okay, if this doesn't happen, then this other thing happens, and that's even worse. And so you kind of watch this kind of play out. Over the past year, we have a record high market capitalization to GDP ratio in the United States. But in the United States, we've had, we've reached very high valuations, even higher by that metric than the dot-com bubble. And so that's interesting because most metrics show that we're probably the second most, expensive ever. But by a couple metrics like price to sales ratios and, market capitalization to GDP, the United States has never been more expensive than it is right now. A lot of things they looked overvalued, but then they got, in many ways even more overvalued. And so that's one of those things where valuation tells you an idea of what the long-term potential is and kind of what some of the risks are, but it doesn't, of course, tell you what's going to happen in the next 6 months or so. And so generally the where the model kind of usually falls short is often things go, say, further than expected and longer than expected before they kind of eventually revert to the model. I think another case was I became a kind of a long-term dollar bear starting in October 2019, and that was because of the repo issue, and so that was an area of my work was really useful because a lot of people were kind of debating on what the repo issue was, and my model is very helpful kind of guiding through that and kind of figuring out what that was. And so I became more dollar bearish, but then of course the pandemic came. We had that dollar spike, and so basically we had these like multi-month deviation from what was otherwise a dollar bearish trend starting to form. And so that whole thing took a couple extra months until we actually saw the down leg eventually happen. And so that's an example where you can have a model, but then a real world event comes and says, okay, your model aside, we're going to push that whole thing back 6 months because it's the real world. And so what made this 2020 to 2021 period somewhat different then is that broad money supply actually did go up quite a bit. And that's because unlike the 2008, 2009, all the way up through the years after period, this time they actually did send a lot of money to people. And so what that did was that actually increased the broad money supply, because the way that the mechanism there works is the Treasury sent people money out. They're like, you get a car, everybody gets a car. Then they issue bonds to pay for that. But then instead of the private sector buying those bonds and that draining cash from the system, the Federal Reserve creates new base money and buys those bonds. And so the way that it gets into the broad money supply and out of the Chuck E. Cheese area is that physical component where they literally send you the check. And so I think they're generally going in that direction, where they're because basically the situation's worse than it was in 2014. They're unlikely to repeat some of those same issues, but it is something to watch for decision points to see, okay, if say the dollar bear thesis for the next couple of years is like a base case, but I can envision a scenario where that we detour and have like a dollar spike until they have to reverse course again. And so it's basically trying to monitor things in rate of change terms, pay attention to what the Fed's talking about in terms of these facilities, and kind of updating as we go along. Basically, there's an order of things they could taper. So before they hike rates, they probably would start dialing back their asset purchases. They're still purchasing treasuries and mortgage-backed securities at a rate of about $120 billion per month. And so they could start dialing that back, to 80 billion to 40 billion, before they look at hiking rates. And the longer-term problem with hiking rates is that there's so much debt in the system that every time they hike rates, they basically start running into a credit issue. And I often formate things as kind of an if-else equation, where it's like, okay, here's the long-term base case, here's where the breaking points seem to be, but there are a couple decision points ahead that are worth watching. And so, for example, one of the decision points I was watching was, back in 2019 or so, I was okay, when we have the next recession, we're probably going to have a very big fiscal response, just because there's almost nothing else they can do in terms of monetary policy. We're probably going to get a lot of fiscal policy. But then the question was, when March, for example, is playing out, it's like, okay, let's see how this goes. And then so it's kind of like we're watching the decision points play out and saying, here's what I think is going to happen, but we have to actually see it if it's going to materialize, and then adjust if certain things start to happen. And so, I try to incorporate the political realities into any sort of forecast that I do, and always think in terms of probabilities, base cases, kind of understanding points where it could start deviating from the base case, and kind of map it out like that, and then change as we go along. But when you look back at that 2014 period, they ended up doing reverse repos for like 4 years. That whole kind of 2014 to 2018 period, they were just doing tons of reverse repos. And so they can actually do this for quite a long period of time. They start to run into issues if it gets really big, which we're kind of in the process of testing. And so it is one of the main things that I'm watching right now to see if it leads the Fed to kind of shift anything faster than they expected. But they seem to be going in that more like kind of permanent facility route, which is essentially kind of the Fed taking over more and more of the liquidity markets, and so that's kind of a whole separate discussion. But basically, if you were to see them say, okay, we're gonna stop QE, like tomorrow, well, that changes a lot of how things are currently priced, and so there are kind of risks to watch in terms of how this might affect their monetary policy. And so one thing I do is I go look, I kind of, I love these long-term data sets. A lot of things they looked overvalued, but then they got, in many ways even more overvalued. And so what made this 2020 to 2021 period somewhat different then is that broad money supply actually did go up quite a bit. And I often formate things as kind of an if-else equation,